Ladies and gentlemen, good day and welcome to the H2 and FY25 earnings conference call of Vinyas Innovative Technologies Limited, hosted by Aurum Connect. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Kaushal Shinde from Aurum Connect. Thank you, and over to you, sir.
Thank you. Good afternoon, everyone, and a warm welcome to all of you. I'm Kaushal Shinde from Aurum Connect, representing the investor relation team of Vinyas Innovative Technologies Limited. On behalf of the company, I would like to thank all for joining us for the earnings call of H2 and FY25. Before we begin, I would like to state a brief cautionary statement. Some of the statements made during today's call may be forward-looking in nature. These forward-looking statements are subject to certain risks and uncertainties that will cause actual results to differ materially from those expressed or implied. These statements are based on management's current expectations, assumptions, and information available as of now. Listeners are therefore advised not to place undue reliance on these forward-looking statements when making any investment decisions. The purpose of this call is to share insights into the company business, performance, and financial results under review. Now I am pleased to introduce the members of the management team present with us today. Mr. Narendra Narayan, Managing Director, Mr. Sumukh Narayan, Full-time Director, Mr. Balaji Bhatt, Executive Committee Member, Mr. Amitwa Muzamdar, CFO, Mr. Subodh, Company Secretary and Compliance Officer. With that, I now hand over to Mr. Narendra Narayan for his opening remarks. Thank you, and over to you, sir.
Good afternoon, everyone. Ladies and gentlemen, a warm welcome to each one of you as we gather here for a conference call of Vinyas Innovative Technologies Limited, where we aim to delve into our exceptional performance during the second half of the year 2025 and final results of 2025. Before we delve into the specifics of our financial results, allow me to provide an insight into our company's journey and achievements. I, Narendra Narayan, Managing Director of Vinyas Innovative Technologies Limited, founded in the year 2001, Vinyas has evolved into a leading electronics manufacturing service provider with over 2 decades of operational excellence and 3 decades of domain expertise. We serve as a trusted partner to global OEMs and ODMs across critical sectors, including aerospace, defense, medical, and industrial applications. Our company operates on 2 integrated service models, built to print and built to spec, enabling us to offer comprehensive solutions from concept to production. Thus, dual approach has strengthened our position as a strategic manufacturing partner worldwide. What sets apart is our focus on high reliability electronic for mission critical and safety critical applications. We manufacture precision components for cockpit systems, in-flight electronics, medical electronics, and defense platforms that demand the high standards of quality, precision, and traceability. Our state-of-the-art infrastructure of 150,000 manufacturing facilities, 150,000 square feet of manufacturing facilities in Mysore is equipped with advanced SMT lines capable of producing 500 million components annually. We maintain prestigious certifications including ISO 9001, AS 9100, IAT CF 16949, ISO 13485 certifications, reflecting our commitment to quality and excellence. Over the years, we have built a strong relationship with leading clients, including Bell, HAL, and other platforms, other PSUs, while simultaneously expanding our footprint with global OEMs. Our strategic positioning in the defense electronic manufacturing has been further validated through our participation in critical programs, positioning us to capitalize on India's emerging as a global defense electronic hub. Now I would like to hand over to our whole-time director, Sumukh Narendra, who will take you through our overall performance for FY25 and share our exciting growth outlook. Sumukh, over to you.
Thank you, sir. Good afternoon, everyone. I am Sumukh Narendra, Director at Vinyas Innovative Technologies. I am pleased to speak with you today and share an overview of our performance for H2 and full financial year FY25, along with an outlook going forward. FY25 has been a year of strong operational and strategic progress for us. We ended the year with revenue at 396.6 crores, delivering a solid 25% year-on-year growth. EBITDA came in at around 44.4 crores, up 22%, and net profit increased by 27% to 19.4 crores. The second half of the year was particularly encouraging, with 247.1 crores in revenue, making a 37% growth over the same period last year. I would like to highlight that during the year, we booked 737 crores in new orders from both domestic and global customers. We also successfully cleared critical compliance requirements to work with international defense programs and defense clients. We made an entry into the commercial aerospace manufacturing segment. We have had our first assessment with a leading Tier 1 OEM. We have qualified our new cable harness facility within the same premises and also entered into a manufacturing agreement with a medical OEM to start manufacturing for Made in India medical devices. These wins reinforce the trust of our customers in Vinyas for high reliability manufacturing. Looking ahead, we have a strong foundation and a clear revenue visibility. We are well positioned to deliver consistent and sustainable growth over the next several years. We remain focused on execution, deepening customer relationships, and expanding our global footprint to create long-term value for all the stakeholders. With that, I'd now like to hand over to Mr. Amitava Majumdar, our CFO, to take you through the financials in more detail. Amit?
Thank you, Sumukh. Good afternoon, everybody. I am Amitava Majumdar, Chief Financial Officer, and I am pleased to present the details of financial highlights for H2 and FY25. FY25 full year performance, if we can look into that, our total revenue reached to 396.6 crores, representing a robust 25% year-on-year growth from 317 crores in FY24. EBITDA stood at 44.4 crores, showing about 22% growth, while maintaining the EBITDA margin at around 11%. Our PAT grew by an impressive of 27% from 19.4 crores to 15.3 crores. Earning per share for FY25 was 15.43. If we look into the second half of FY25, which is H2 FY25 performance, the second half performance was particularly strong with a revenue of 247 crore, representing an exceptional 37% year-on-year growth. EBITDA for H2 FY25 was 26.7 crores with 32% growth,
with an EBITDA margin of about 11%. PAT grew by 8% to 12.4 crores, and EPS was 9.86. Now, if you look into the balance sheet strength, our net worth increased to 147 crores from 128 crores, reflecting our strong capital base. We maintained a healthy debt-equity ratio of 0.7 times. Our total assets grew to 330 crores, with the current assets comprising of 286 crores. Sector-wise revenue distribution, if you look at, the defense and aerospace continues to be our dominant segment, contributing 78% of the revenue. Industrial segment showed remarkable growth, contributing to about 18.4%. Medical devices contributed to 6.7 crore, and other segments accounted for 7.5 crore. In the cash flow and working capital angle, we generated a positive operating cash flow of 8.8 crore in FY25. Our disciplined working capital management and strong order book provide us with the financial flexibility to execute our growth plans. This strong financial matrices, combined with our substantial order book of about 1,018 crores as on 30th of May 2025, position us well for sustained profitable growth in the coming years. Over to you, Sumukh.
Thank you, Amit. Kaushal, we open up the call to any questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants who wish to ask a question may press star and 1 now. The first question is from the line of Aman Soni from Invest Analytical Advisory LLP. Please go ahead.
Hello, am I audible?
Yes, sir.
Good afternoon, sir. So my first question is on order book side. As our order book is around 1,018 crore, what is the execution timeline for the entire order book?
Good afternoon, Aman. So the order book execution is over the next 12 to 18 months. It's a mix between some of it executing in 12 months, some of it executing over the next 18 months. So the longest period is about 18 months.
Okay, understood, sir. And how is the order inflow expected to be shaped in this year? And how do you view the demand outlook for the current year? Means how much order inflow expected in this year?
Aman, we have programs in the pipeline. The order inflow, we are expecting it to be at the same levels that we had in FY25. Between 600 to 750 crores over the financial year. And that is the outlook that we have for this financial year as well.
And sir, what is the revenue and EBITDA margin target for FY26?
We are expecting to be expecting a 25% growth this financial year as well, and the EBITDA margin will be between 9 to 11%.
Okay, sir. And since we are expecting to system integration apart APCB assemble, I want to understand what product are we targeting and what kind of margin expansion and we targeting by entering into these segments.
So what kind of products we are manufacturing subsystems to different defense programs. So there are multiple subsystems where we will be doing the system level and the subsystem level integration here at Vinyas. The margin profile, we expect it to grow between 2 to 3 basis points on the gross margin side. But it also gives us the leverage of being a full subsystem integrator for our defense customers.
Okay, sir. Understood. Thank you, sir.
Thank you. The next question is from the line of Piyush Arora from Arora Family Holdings. Please go ahead.
Hi, sir. Congratulations for doing the con calls. Hopefully, we get to see more of con calls going forward as well. So my first question is a bit qualitative in nature. Is what makes our business unique? Because there's so many companies now in EMS space and so many companies which are also into defense contract manufacturing. So just in some sort of to get a qualitative answer out of you. So what makes the company unique, sir?
So Piyush, we are what we call as a high mix, high complexity assembly house. So we make critical subsystems for our customers, and we focus on fairly complex both PCB assemblies as well as system assemblies for our customers, and we focus on low and medium volume manufacturing. So that is what we are focused on, and that is the differentiating factor for Vinyas. We are not like a different EMS where we cater to the low mix, high volume manufacturing. We are what we call in the EMS segment a high mix, low volume or a high mix, medium volume manufacturer.
Right. And qualitatively, sir, how are we able to hire engineers or train engineers, or what type of processes that we have in place which we make sure that the company scales well? What type of bench strength do we have?
So what we have taken it up is to ensure that we are up to date with all the necessary certifications and the qualifications, as well as the licenses that are required to continue the manufacturing. So AS 9100 is a stepping stone to enter into the defense segment, but there are different licenses which allow you to participate, qualifications that allow you to participate in different segments, some of it for critical manufacturing, some of it for ground-based manufacturing. So Vinyas is striving to ensure that we keep in line with all the qualification requirements, as well as quality plays a very crucial part in the manufacturing of critical subsystems. We track our quality yields to ensure that we keep up to the mark. In terms of manpower, we've been successful where our attrition rates have been low, and we have had a very strong internal training program here at Vinyas, where we have been able to consistently give internal training to our operators so that we can upskill them as well as improve the process within Vinyas. Engineering strength, we are predominantly a manufacturing house. The engineering strength predominantly comes from production engineering, and we don't have an engineering, we don't look at the engineering side from a development side. We are predominantly a production engineering strength. I hope I answered your question.
Yes, it was quite comprehensive. So just another question, this is reference to the slide 8 in the presentation that we have, that is on growth momentum factors. So if I club the entire opportunity sizes, is my understanding correctly in terms of next 4 to 5 years or whatever opportunities that we have in different verticals, we are looking at an opportunity pipeline of close to 9 to 10,000 crores over next 4 to 5 years?
Yes, that's right. So these are based on the programs that we are a part of and the programs that we are working towards. So that is the opportunity size that we are working towards.
And so just last bit of question from my side on the margins bit. So I think FY22-23, we had 2 years where our margins, I think 21 and 22, where our margins were 6% type on EBITDA level. But now we see that margins have hit between 9 to 11%. So anything that we should be careful of in terms of assessing the margin profile of the company, that it could lead to a temporary basically blip in the margin if some raw material cost increases, or you will be very confident that margins will remain between 9 to 11%. And because of the type of opportunities that you're seeing, do you think there is operating leverage built into your business that this margin profile could also move up over next 2-3 years?
I would say that we are very confident that we would remain in the margin profile between 9 to 11%. There is also operational efficiencies as well as programs maturing, which has allowed us to reach this margin profile. The next 2-3 years, I don't see the margin profile changing. It would take us some more time to see a better margin profile coming into the business.
Okay, sir. Wishing you all the best for the future and hope we see more con calls also going forward.
Thank you.
Thank you. Before we take the next question, I would like to remind participants that you may press star and 1 to ask a question. The next question is from the line of Yash Bajaj from Lucky Investments Manager. Please go ahead.
Yes, good evening and congratulations for such a performance. Some of my first question is regarding the export business which we have, which is part of the order book this year. I mean, can you help us understand this part of the business which we have won this year and what is it related to? And what is there any kind of shift in terms of was it a China plus one kind of opportunity?
Yes, good afternoon. So the export orders business that has come in, one in terms of the medical device segment has purely been a China plus one to cater to the Make in India requirements that we have. So predominantly it was a localization requirement for our customer to localize their manufacturing in India. With respect to the defense business, with the necessary certifications that we have on hand, we've had a larger exposure to export orders that have been coming in for Vinyas. We've had close to 22-23% of our orders coming in from export, and that has predominantly been driven based on the licenses and the approvals that we have received.
Okay. And regarding the Francis Kabi order which we won related to medical device, that's it is for their domestic part of the business, right? It's not outside India, right?
No, as of now, it is for domestic manufacturing in India.
Okay. And how do you see this part of the business? How large is the opportunity in this segment, and how is the conversation going regarding that?
We've completed all our certifications and approvals that are required, and we are into the first phase of manufacturing. We expect it to ramp up over this financial year, having the first few thousand units going out to Francis Kabi over this year.
Okay, got it. And my second question is regarding the current capacity. What is the current capacity today, and what kind of revenues can it generate?
Capacity, since I touched upon, we are a high mix, low volume manufacturing house. We do a lot of varying mixture of products. To put a value to it, we are at around 35% capacity today, and we can scale up to between 1,200 to 1,400 crores of revenue with the current capacity that we have. So we have all the necessary capex, which was done about a year back, to sustain the growth that we are looking at over the next 2 years.
Okay, understood. And regarding just on the balance sheet side of the piece, is that there was a sharp jump in the receivables and inventory as of year end. So any reason related to that?
There has been the supply chain was on and off over the whole financial year because of the Middle Eastern conflict. We have an exposure to the Israeli supply chain. So because of which, over the last quarter, we had a larger portion of the manufacturing happening. And that is why we see a larger receivable on the balance sheet. We expect that to it has smoothened out over the first quarter of this year, so we expect it to improve this year.
In terms of inventory management, it has been improved actually substantially compared to last year.
Okay. Got it, sir. My next question is on the margin side. Our H2 margins, H2 25, were on a slightly lower side versus the previous year similar half. So is it related to any mix change? If you can just help us understand that.
Yes, it is related to a mix change. We had larger volume of slightly lower margin boards that were going out, which was contributing to the revenue. So that is predominant reason for the lower margins in the second half.
Okay. But the margin range should be should be around this band only, or are there any levers for improvement considering we are getting into export and medical?
We expect it to remain the same, at least for the next 2 to 3 years.
Okay. Fine. Can I take more questions, or I'll just get back to the queue?
So you can go ahead.
Sure. Thank you. So, on the commercial aerospace side of the business, which we have recently entered into, if you can just help us understand what is it related to? Is it domestic, export? And if you can help us understand what are the components we are providing to them?
So we were in the process of getting the necessary certifications. We have completed the process. So one of the foreign OEMs has cleared the plant, done the audit of the plant, and placed the first purchase order for the validation of the manufacturing process here at Vinyas.
Okay.
So this is our first step and the first exposure to the whole segment. It is we are working with other OEMs for qualification of the plant, and we will be in a better position to give more updates maybe during the first half of this financial year.
Sure. Okay. Fine. Okay. That's all from my side. Thank you, team, and all the best.
Thank you. The next question is from the line of Nikhil Singhania from Singhania Family Office. Please go ahead.
Thanks for the opportunity. Sir,
Sorry to interrupt, sir. I would request you to please use your handset.
Yeah. Is it audible?
Yes, sir.
Sir, when can we see the full optimum utilization of the capacity?
The full optimal utilization of the facility would be in the financial year 27. On the defense and aerospace side, qualification and approval of the facility usually takes a year and a half to 2 years. We expect the full optimal utilization of the facility next year.
Okay. Thank you so much.
Thank you.
Thank you. The next question is from the line of Vikram Sharma from Niveshaay. Please go ahead.
Hi. First, congratulations on good set of numbers. So, sir, are we receiving any inquiries regarding the faster execution of current program where we are working on, like from 5 to 7 years period to 3-4 years kind of thing, post this war scenario?
Hi, Vikram. So there is something called as an emergency procurement process that the Indian Ministry of Defense has. We have received some inquiries. We are working on the inquiries. So it is very fresh. If we see something converting, we will surely make the necessary announcements to the stock exchange.
Okay, but even on the current programs where we are working, where the timeline was like supposed to be like 6-7 years, there are we experiencing any like faster execution or anything?
There is a push both from our customers as well as from the government to fast track the programs. It is very early for me to comment on where we are with respect to the whole process.
Okay. And what is our like approx current bid pipeline which we generally share
We currently have an order book of about 1,018 crores. We expect the order inflow to be at the same levels as last financial year. So with a 25% growth this year, we expect the order book the confirmed order book to grow to about 1,500 to 1,600 crores by the end of this financial year.
Okay. And the last question, when we say like we are in a segment like where is the complex product and a low volume segment, but when we compare our margin with other players, so margins are on the same lines, like even other EMS players are making 10-11% margin. So what could be the reason for this?
The mix, so all of it, end of the day, is a build-to-print manufacturing that we do. The differentiating factor is we do high mix, low volumes. So here the complexity is higher and we do lower volumes of the manufacturing. But end of the day, it is a build-to-print operation that we are doing. So that is the reason for our margin profile. We expect the margin profile to be between 10 to 11%. Also, in our case, the raw material costs are significantly higher. So the value add portion, end of the day, comes to between 10 to 11% in terms of EBITDA.
Okay. Thank you, Sumukh.
Thank you.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. The next question is from the line of Chetan Phalke from Alpha Invesco. Please go ahead.
Good afternoon, sir, and thank you for the opportunity. Sir, you just mentioned about some supply chain disruptions from Israel's side. So how much of our business is Israel business versus non-Israel business, if you can just help us understand?
We supply some of the programs to public sector undertakings like Bharat Electronics and HAL, which are technology transfers that have happened from Israeli OEMs to our public sector undertakings. In terms of supply chain side, we have an exposure of about 27 to 30% of our programs have some dependency on the supply chain coming from Israel. Some of the critical components as well as some of the made-to-order parts come from the supply chain from Israel.
Okay. And sir, in last year's annual report, I was just looking at some numbers. So almost 200 crores of raw materials were being imported. This year, obviously, the number will be much higher. So how much of are we building any in-house capabilities as well, let's say a backward integration into PCB boards or anything like that to reduce our import dependency and do more and more value addition from in-house capabilities? If you can just help us understand overall picture on that side.
Very honestly, our supply chain is predominantly very low volume, so we are not looking at the parts that we can actually look at are PCBs and mechanicals, but they don't contribute a significant portion. So as of now, we are not looking at any backward integration as such. Regarding the electronic components are predominantly imported, and since we deal with it at such low volumes, I don't see any value add in actually looking at a backward integration on this aspect.
Mm-hmm. Okay. So sir, in terms of, let's say, the volatility in the component prices, how does the pass-through arrangement or the adjustment with our customers work? I mean, is there any bill of material difference arrangement with that?
So customers, we have two protections. One is a foreign exchange rate variations as well as POM price parity variance. So we do get both the protections for majority of the programs. So those protections are in place to protect us from any volatility that could be there.
Mm-hmm. Okay. And usually, if there is any differential between the quoted price and the actual price of the material, how long will it take for you to get the bill of material difference? Usually,
it happens every 2 times a year. So the cycle happens every 2 times a year to get that cleared and get it aligned to the new prices that are in place.
Mm-hmm. Okay. So this norm is there for Indian companies, Israeli companies, or whoever they're dealing with.
Yes.
It doesn't
Usually there is an approval that is taken before we proceed with the procurement, and there is a reconciliation that happens every 6 months.
Okay. And sir, usually, are there any rejections in our business? I mean, if there is something called rejection rate, or how does that part of the business work? Just trying to understand.
Rejection, the qualification process in the manufacturing facility is thorough enough so that there isn't a rejection that happens at the customer location, usually. So whether it's a PCB assembly or whether it is a subsystem that we are supplying, both of them are completely tested, qualified before they are shipped. So rejection rates, internally in the process as well, we have stringent quality requirements where our final yields are above 99% because of the high mix and the high complexity that we manufacture. So that is not really a large portion of, that is not a significant portion, rejection is not a significant portion of the process, usually.
Okay. And if at all there is any, then we have to absorb it.
Yes. It doesn't mean that there will be, there is no rework possible. There will usually be a rework, and the product is moved through the complete qualification process and delivered to the customer.
Mm-hmm. Okay.
Sorry to interrupt, sir.
Yeah.
I would request you to rejoin the queue for your follow-up question.
Sure.
Thank you. Ladies and gentlemen, I would request you to please limit your question to 1 per participant. If you have a follow-up question, I would request you to rejoin the queue. The next follow-up question is from the line of Nikhil Singhania from Singhania Family Office. Please go ahead.
Thanks for the follow-up question, sir. Sir, as you guided, we can achieve optimum capacity utilization by FY27. Is it fair to assume we can achieve 1,000+ crore revenue by FY27?
In terms of capacity, yes, but we are looking at a 25 to 30% growth year on year. So I wouldn't, in terms of capacity, what you're saying is right, but I wouldn't commit to a revenue target of 1,000 crores for FY27.
Okay. And so margin, going forward, margins should be same in next 2 to 3 years?
The margin profile, we are expecting it to remain the same for the next 2 to 3 years.
Okay, sir. Thank you, sir.
Thank you. The next question is from the line of Priyankar Sarkar from Square 64 Capital Advisory LLP. Please go ahead.
Hi, sir. Congratulations to the entire team on a very good set of numbers. I just have one question. In terms of the working capital, sir, let us say this year, even last year, the working capital was close to 50% as a percentage of sales. So is there a target we have that we want to bring it down to over the next 2 to 3 years for the working capital?
Hi, Priyankar. So the target is to reach about 30%. So we are working towards that. This year was more on we had a bit of supply chain disruptions, and with that, we see a large receivable, but we are working towards a working capital range of about 30% of the revenue.
Perfect. Thank you very much, and wish you all the best.
Thank you.
Thank you. The next question is from the line of Ravi Mehta from OneUp. Please go ahead.
Yeah, hi. Just wanted to check on the slide 8, the 10,000 crore opportunity that you have. Since you are participating in all of them, I believe, wanted to understand, are there any risks to the size of the opportunity changing, or the the timelines getting elongated, or some more peers coming in and sharing the pie? So how do you see the addressable or the winnables? Any risk that you would like to highlight?
The risk is, I would say, the risk associated with any kind of a defense program. All these defense programs, there are push-outs. So the major risk that we foresee is delays in the programs getting sanctioned and delays in the program getting to critical stage where we get into a serious manufacturing stage. So that is the major risk that we expect, and we foresee for the pipeline that we have on hand.
So when you say 5-year kind of a term that you've highlighted, does that factor these kind of risks that you already built in, or this can be over and above?
This will be over and above, because some of it is beyond our control. We have had programs delayed by 2-3 years.
Sure.
So this would be over and above what we have put up.
And when you get to these opportunities and get major wins, what kind of capacity expansion or investments you need to do? Because I think you addressed that your peak revenue from the current setup could be 13 to 1400 crores. But when you go about cracking such a big pipeline, what kind of incremental investments you need to do?
Predominantly on our EMS business, the incremental capex would usually be adding more SMT lines. We factor it at around 600 crores coming in from one SMT line, 600 crores of revenue on the defense and aerospace side. That is our rule of thumb that we use internally for calculating the capex requirements. And in general, as we grow up the value chain, or as we grow up with programs, we will also have to invest on certain equipment to manage, improve the quality process as well. So this would be more in line with the capex that we put in at around 30 crores last year for expanding from one line to a second line. And we expect it to be at the similar level for one single line being invested.
And for other critical equipment or something, will it be another?
That would be more. No, it would be a smaller capex. It would, we expect 2 to 3 crore capex on a yearly basis to support some of these critical programs that we are making.
And given this, supply chain disruption getting normalized, what kind of top line you can achieve with the current balance sheet in terms of capacity as well as working capital, which is already there? Where can you get to without any incremental working capital addition?
In terms of capex, I would say we would be able to do between about 1200 to 1300 crores in revenue. In terms of working capital, we have the necessary working capital to support us for this financial year and the next financial year. We are trying to work with our customers to get advances, and the advances supporting the working capital requirements. Post that, we will have to explore, but that is something that we will come back on the exact numbers that we need to work on.
And for that readiness, we have sufficient unutilized non-fund-based limit with the bank.
Thank you. Sorry to interrupt, sir. I would request you to please rejoin the queue. Thank you. The next question is from the line of Yash Bajaj from Lucky Investments Manager. Please go ahead.
Yes, thanks for the follow-up. My question was on what is the mix of our current order book in terms of defense, medical, and industrial?
The mix would be about 80% from defense, 15% from 15 to 18% from industrial, and the balance would be medical.
Okay, got it. And just on the build-to-spec side of the business, I mean, any developments which we have had in the current year? I believe we were looking at the medical devices side from a build-to-spec side. So, any developments over there?
Nothing substantial that has come through in this financial year on the build-to-spec side, yes.
Thank you. The next follow-up question is from the line of Chetan Phalke from Alpha Invesco. Please go ahead.
Yeah. Thank you for the opportunity again. Sir, out of this 1,000 crore order book, how much will be offset and how much will be Make in India orders, and what will be the margin difference? Is there any margin differential between these two orders?
Predominantly, I would say there isn't. The offset programs have, to a large extent, completed. The order book, I would say close to 80% of it is Make in India programs, predominantly catering to the Make in India requirements for defense. We have most of the programs with respect to the offset requirements have been. We have some programs which are legacy programs, but don't add a significant portion as it was earlier.
Thank you. As there are no further questions from the participants, with that, we conclude today's conference call. On behalf of Venus Innovative Technologies Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.